One stock that is in focus today is Orient Cement. Mr. Deepak Khetrapal, MD and CEO, joins in to decode Q4 numbers and what's in store going ahead. Welcome to the show, Mr. Khetrapal, and always a pleasure to speak to you.
Thank you very much. Delighted to be here. Thanks for having me.
Always a pleasure. Mr. Khetrapal, my first question coming to you is overall, if you see in terms of the performance, it's a beat on all fronts in terms of what the street was estimating as well. From your internal perspective, how are you viewing the numbers?
Number as far as the Q4 is concerned, they're a lot more reassuring. They are back to where we are used to be. The year as a whole has obviously left us a little unhappy. Simply because the first half for us was rather poor. And I've already acknowledged that publicly to my shareholders. But third quarter, we started seeing the improvement coming back. Fourth quarter is a lot more stronger. But even then, I think there is still room for us to become better, not so much in terms of what we can do as management, but more importantly, in the market opportunity where the demand is. Now, if you look at last year, whether it's Q4 or for the year as a whole also, we've had growth in demand, we have growth in our sales, both in volumes and in rupee terms. Prices actually have stayed steady. They have not gone up, but they haven't gone down. What has hurt us and the rest of the industry throughout the last year, including Q4, has been the extremely unusual and very sharp inflation in our fuel costs, which we were not able to pass on to the markets. So the entire, I would say, comparison when we make with the previous year or even the last quarter with the previous year, same quarter, most of the parameters are online, excepting that market prices have not risen enough to absorb the cost increases that we had to take because fuel costs are global costs today. And we really had no option but to keep reducing at that. We are assuming now the two things which are happening going forward. One, there are a few more actions that we as management had initiated. And those include some significant cost reduction measures, including the waste recovery plant that we did not have in our company. So at our Karnataka plant, a waste heat recovery plant is under commissioning as we speak. And we should start getting power from that within this quarter, well before this quarter ends. We are going for more solar power. So we are putting in these investments. These projects need a little while, but when they kick in, they start giving you savings on the further cost savings from where we are. Just to give you and your viewers a reminder, in the cement industry, we are very widely acknowledged as the most efficient cement producer in India. And also that reflects in the low cost of our operations, whether it's variable cost or total cost. So efficiency-wise, we have enough recognition, acknowledgement, even from our own peers. To go down from where we are, it's not just a question of efficiency. It also means that we have to invest money in a few projects. And those are the kind of projects we have mentioned to you. Waste heat recovery plant under commissioning. We are installing a fly ash rake handling system, which will bring down our logistics costs for fly ash that we bring in. Solar, we are talking about more and more alternative fuels we are talking about that come at a fraction of the traditional fuels like coal and petcoke. So those actions we are taking. And we're also hoping that after, I would say, the cement prices not being able to absorb the ongoing cost increases, we are hoping that in the new financial year that we are into now, hopefully some respite will be available from the markets and we'll be able to take some price hikes which will sustain during the year. So that's the entire summary of where I believe Q4 and last year has been and how I see things going forward.
Right. So that's an interesting answer as well, and gives a lot of perspective to the investors and the viewers. From here on, if you have to look at the next 2 years, how are you viewing growth? Will we be able to outpace the industry growth? And if yes, by how much?
Look, to outpace the industry growth, largely you need to have a few levers in hand. One of the constraints why though I would love to in almost every company say they would want to outpace the industry. Today, our problem is that one of our plants in Karnataka, which we are running, we actually last year itself, we have consumed 100% of the clinker capacity there. So I have a bit of a capacity constraints for the next 2 years to be able to outgrow the industry. But we will try and sort of move our clinker from one plant to the other and at least stay in the market, retaining our market share. Growth in market share perhaps will have to wait till we invest in brownfield expansion, which are again in the offing. If your audience are interested in the details, within the next 6 to 7 months, we intend starting construction of brownfield expansion of our capacity at our Karnataka plant, which is in district Gulbarga. So that once we start, it will take about 15 to 18 months before the capacity actually becomes available to send to the market. So that will take us a little while. In the meantime, the other plants from where we sell cement, which is one is in Telangana and North Telangana, and the second one is in Jalgaon in North Maharashtra. So at these two plants, we do have some spare capacity. And we will try and sort of in a way grow around those markets, and around the Karnataka plant markets, perhaps the growth may not be as sharp. So net, we are still talking about against nearly 5.8 million tons of sales that we achieved in FY23. We are targeting between 6.3 million as a conservative estimate, 6.3 to 6.5 million tons of sales in FY24 that we are starting now.
Right. Moving from here on, another question I have is with regards to where the replacement cost of a cement plant goes. Now, usually that's somewhere in that $100 per ton kind of a range. And when we compare Orient cement to peers, it's somewhere still in the lowest bracket. What's the reason for that? Because that's a steep discount.
There's a bit of a history to it. Just to sort of refresh people's memories, the memories are rather small. If we looked at where Orient Cement was in terms of market pricing in around 2016 or thereabouts, we were actually being traded 230 rupees, 240 rupees. Around that time, to be honest, we became ambitious, and some of our investors somehow started believing that we are trying to grow too high, too fast. And they sort of, in a way, discounted our share, and it happened around that time. And post that, and then when COVID hit, we had about 1,300 crores of project debt on our books. That obviously created a lot of worries in some of the investors' minds actually, saying how will they, if the COVID has hit, how will they service the debt? While that anxiety was there and the markets sort of discounted us, the fact of the matter is in FY20, 21, 22, consistently we've actually surprised the market with how strong we were, and we more or less liquidated our entire debt during this period. Now that liquidation of debt has, like I said, has happened, but somehow the re-rating of the company, which was actually discounted because the debt has still not happened. So I guess the investors are waiting for some trigger from our side, which we are trying to provide, one in terms of making sure that we grow and we improve our profit margins. Secondly, we also start investing back in growth, start raising debt again, because if you remain debt free, you will not have capacity. Like I'm saying, one of the plants is already completely sold out. So we are taking all these steps and also taking steps to invest in what I call future-proofing investments, whether preparing the company with the right IT backbone, digitization, more and more alternative fuels being used. So all those actions are being taken in the expectation that at some point in time, investors will become alive to what our potential really is.
Yeah, you want to just have a sip of water or something?
Yeah, if you can give me a second, I will just completely dry throat. Just 1 second.
So overall, till Mr. Khetrapal is back, clearly, what he's indicating as well in terms of strategy that yes, the debt on the books has consistently come down now, but now is the time where they will start increasing debt as well and take a lot of expansion plans in terms of capacity into consideration. Overall, 8.5 million tons is the kind of capacity that they have. Now, what that utilization looks like is something that we need to check. Overall, in terms of debts as well, at the end of the third quarter, the debt was around 400 odd crores. So from here on, where the debt is going to move is going to be something we need to watch out for. Apart from that, if you've seen from here on, going ahead as well, it's an interesting capacity expansion plan that we will speak to Mr. Khetrapal about. Yes, welcome back, Mr. Khetrapal. So overall, as you mentioned about the debt as well, around 400 odd crores is where it stood at the end of the third quarter. From here on, if we are looking to raise debt, what's the kind of capacity expansion plan that we have?
As I mentioned earlier, debt has to be looked at while we say 400 crores overall on a particular date. The debt which is more consistent is the term debt. or the project debt that we had. That is, as we speak today, is about 240 crores. And we are consistently repaying that every quarter. So that will keep coming down. In terms of, just as a reminder, against barely 240 crores of long-term debt, our net worth is 1600 crores plus. So it's actually very, very low gearing, and there is hardly any repayment obligation today. So when it comes to expansion plans, we will stay sensitive to how our balance sheet is, and we would definitely want to start leveraging the balance sheet to bring in the growth, organic growth that we need. And the first project that we are going to be kicking off is later on during this year, where my own expectation within Q3 will start construction of a brownfield expansion project at our Karnataka plant, as I mentioned, where the clinker utilization is already at 100%. And that will take 15 to 18 months to get delivered. So we are saying by end of FY25, we would have increased our capacity by about 3 million tons. So from 8 million to 11.5 million tons will be brownfield expansion at Karnataka. We also have announced the intention, and timing of that right now is not announced, but we will also do a brownfield expansion at our Telangana plant for clinker. And for that, we will be putting up a split grinding unit in, I would say, the eastern part of Maharashtra or the southern part of Madhya Pradesh, where till a few weeks ago, we actually had not just shortlist, we actually signed up a site also in Maharashtra in the Vidarbha region to put up a split grinding unit. So the intention is that we expand clinker capacity at our Telangana plant. And for grinding of cement, we actually go to this new split grinding unit in Vidarbha region or further up north in Madhya Pradesh, which will also provide to us diversification of our markets away from the markets of AP and Telangana. So that's the second part of our growth strategy. Third, we had a very old mining lease which had run into some bit of a dispute with the government. That has been resolved. We right now have Rajasthan mines back with our company, and that gives us a new opportunity to put up a greenfield unit in excess of 3 million tons. So one after the other, Karnataka, Telangana, Rajasthan, these are the growth plans, and the capacities will be the Karnataka plant has had 3 million tons. Similar capacity at Telangana plus the grinding unit in Madhya Pradesh, another 3 million tons, and 3.4 million tons in Rajasthan is the total growth potential based on the limestone we already have.
Right. And what's the kind of capex that we have for this kind of an expansion?
See, total, if we are talking about in excess of 9 million tons, this obviously, because it's brownfield, it will not cost as much as a greenfield would, but Rajasthan is greenfield. So our own estimate is the total capex on this very growth plan is going to be around 6,000 crores.
Right.
But it's a function of if you're going to do it sequentially and not parallelly, not at the same time, then we have enough time to keep generating cash and keep not leverage or rather over leverage the balance sheet.
Right.
Our board mandate is very, very clear. We would not want to go way beyond 1.5, 1.6 times in terms of debt equity. And even debt to EBITDA will try and manage within 3.5. So that is something that we are going to be respecting all the time, even while we chase this aggressive growth plan.
Right.
And if at any point in time, the growth becomes imperative and the board and the shareholders believe that we should grow faster, we have the limestone, we can grow faster. At that time, we could even consider strengthening the balance sheet by bringing in more equity as well. So these are things which will get determined, I think, over the next few quarters. But as on date, firm in hand plan that we want to go ahead with the Karnataka expansion.
Right. That's an interesting one. Now, that's on the production manufacturing side of it. When you come to the sales side of it, majority of our concentration is in the western and the southern part of India. Now, these regions have their own problems in terms of capacity as well as pricing. So is there any strategy with regards to expanding to the other regions as well from here on?
See, the expansion into other regions can come if we have limestone reserves, right? Cement just can't decide to go wherever the market is. So from that perspective, getting Rajasthan mines back is the biggest diversification potential or scope that we have right now, as I mentioned to you right now, correct? Second, if you just recall, I talked about brownfield expansion in Telangana and a split grinding unit somewhere in Madhya Pradesh. That also will take us into markets where we are not today. So these expansion plans very clearly at Telangana and the expansion plan in Rajasthan is part of exactly what you are hinting at, that we should have diversified markets compared to the markets in which we've been traditionally exposed. So we're working on that through these expansion plans.
Okay. And apart from this, if you see from a cement pricing perspective, what's the trend now looking like?
Well, as of now, if we speak, the prices continue to be how they were in the last quarter. We haven't seen any improvement in prices in April. And as I mentioned earlier, on pricing, a small company like us, we are price takers. We are not price makers in the market. But what we try and do is that while at the commodity end of the cement market, prices are given to us. What we have successfully managed to do over the last, I would say, 3 to 4 years, we've actually been launching new premium brands and premium products. And it will be interesting for your audience to understand that a small company like ours today sells a premium product in the market, which perhaps is the most expensive cement being sold in the market. We call it Birla Even Strongcrete. That's our super premium brand. And that we sell at a premium of 45 rupees over the normal cement. And last year, when the demand was soft, this premium, super premium cement I'm talking about, it actually, we had some degrowth in the consumer market, B2C trade segment as we call it. The super premium brand grew at 17% in a year where we lost the consumer sentiment or consumer demand. We launched another premium brand, which we're calling Orient Green. That also is finding good traction. If we put both the brands together, Orient Green along with Strongcrete, the other super premium brand, the growth in these premium brands put together is 22% over previous year. We are on the cusp of launching another specialized premium cement with another brand. So all our effort really is that can we create specialized, very specific use and targeted products for the consumers, which get us a premium over whatever the market prevailing price of cement is. So that's the strategy to de-risk we being caught in poor pricing cycles.
Right. And from a demand supply perspective, taking the kind of government investments that the government is looking at from an expense perspective with the election year here nearby, how is that demand trend looking like from a cement sector perspective?
The fact of the matter is that demand, we all know, has to be up, especially when the elections are just about a year away. All the historical trends tell us that demand should move faster. But as I'm speaking to you today, do we see the traction or the high push in demand looking in the month of April? It has not looked so. We are also surprised because normally pre-monsoon, April, May, also June tends to be a very, very high demand period for the industry as a whole. Somehow that very high, it's demand is good, it's steady, but it's not as high as it needs to be. So I'm calling this current demand situation a little below par. But hopefully, as the year progresses, still very early days in the new financial year. As the year progresses, we are expecting that the demand definitely should improve. And the government's thrust on completing many of the projects pre-election should help the overall demand.
Right. So I think from here on, it's going to be an interesting sector to watch out for as well. Thank you, Mr. Khetrapal, so much for joining us on the show and giving us those views. Stay safe and speak to you soon again.
Thank you. Same to you. Thanks. Bye-bye.